Today's number, $30,000. That's how much Bay Area consultants charge to help parents name their babies. Yeah, true story. When my partner was giving birth, she was screaming at me saying, "Oh my God, this is so painful." And I said, "Hey, look, I wanted to put it in your ass and you said it would be too painful. Now look at you." Is this the bridge too far, Ed? Is this the red line?
I don't think this is the red line. Is there a line for just strangeness and weirdness? Is there a line for that?
Economically independent. I'm the largest shareholder here. I'm not sure I can be canceled.
Independent media. This is what we get for trying to break away from the mainstream.
How are you, Ed?
I'm doing very well. How are you?
Why is that? What's going on?
Why am I doing very well?
Yeah, why? What's going on? What's going on? What's going on?
I don't know. I had my coffee. I had a good night's rest. I actually got a party I'm going to tonight hosted by the one and only Mooch, which I'm pretty excited about.
The Mooch?
He's celebrating his book, the 15-year anniversary of his book, Goodbye Gordon Gekko.
I'm sorry. They have parties to celebrate anniversaries for books now?
Which I respect because he's figuring out ways to bring people together and to rent out a nice place. I mean, I think it's good stuff. I know you're going to shit on it, but I just want to get my opinion out there first.
I didn't get invited, so I'm not a fan of this party. How's things on the home front? Are you living with your girlfriend yet?
I've been living with her for a while.
I knew that. How's it going? And how's it going? Have you guys got a dog yet?
No, I think I've told you this before. I'm not the biggest dog person.
Okay, so all you need to do to fix that is to get a dog, okay, or get another dog. Your dog sounded awful. Occasionally get a bad dog.
That's good. You remember I had a bad dog.
Public service announcement, and I'll link this back to our show, The Markets. We talked about how sales of Hamburger Helper and Rice-A-Roni are up, which is a negative forward-looking indicator for the economy. Another negative forward-looking indicator is that people surrendering their pets to shelters has spiked. All these people who thought it'd be a good idea during COVID to get a pet, and now they're struggling economically, turning their dogs back in. There are so many amazing dogs at shelters right now. If you just go to Google and type in, or go on Instagram, type in Brooklyn Shelter. And I've had mutts and I've had purebreds. Actually, I've only had one purebred, and she's a total neurotic bitch. But the mutts you get at shelters are just amazing.
Are they not a little crazy themselves? I mean, you're kind of signing up for an emotionally damaged animal, no?
No, dogs out of shelters, mutts are, first off, it kind of makes sense. Purebreds are literally like the Norwegian family monarchy in the 18th century. Like half of them are, have 3 legs and are, no teeth because there's so much inbreeding. When a dog gets popular, they become shitty dogs because they get overbred. Mutts are absolutely the way to go. They're outstanding.
Do I have to go for a rescue dog? I mean, that's really what I'm zeroing in on here. Someone who's sort of abandoned their dog, and then the dog is definitely very damaged and very upset. It's probably going to be a little weird. Like, I'm looking for something very simple. I want to basically not have to deal with my dog very much if I'm getting a dog, which I'm not going to.
The premise of your question is factually incorrect, because the dogs are surrendered because usually for economic reasons, or people are moving, or people get a job and they can't be at home. But mutts, it's almost as if they know, especially I got my last dog from a shelter. It's almost as if they know you've saved their life and they're really grateful. Whereas my Great Dane is a total expectant bitch. She expects to fly business class, wants jewelry on her birthday. And this is a Great Dane. Whereas the rescue pup that I picked up, our Puerto Rican rescue hound.
She's writing thank you notes when you take her on the NetJets.
I'm pretty sure she's a sewer rat. I'm not even sure she's an actual dog. But he is, and he's awesome. He tries to hump everything. He's awesome. He's really, I'm telling you, rescue or dogs from shelters are absolutely the best dogs. One, they're usually already spayed or neutered. 2, they're already trained. And you're saving a dog's life, and they're fantastic. I've had such good luck with dogs from shelters, and you can go down, and right now you can find so many amazing dogs at shelters because they're just brimming. There's just too many dogs. Anyways, and one, and Ed, I think you need this. They're very good for your mental health.
Mm-hmm.
They're very calming. And I'd say next to working out, it's been my antidepressant, have been my dogs. My kids come home and then, really bum me out, but then I hang out with the dogs and I'm fine. And then they're a fantastic security system. So all the surveys of incarcerated people who commit crimes say the one thing that always turns them off is they never go into homes with dogs. So it's an incredible security system. They teach your kids, which you will eventually have. I'm convinced you're on the verge of procreation. They teach your kids about loss and responsibility, and they make you more interesting. Like you're a little rough around the edges. You're a little rough around the edges.
That's what I need. I need to be more interesting to people.
They soften the ed. They soften the ed. Seriously. It's a great way to meet people. I go out in the park and people come up and just start talking to you because you have a dog. It's really nice.
Mm-hmm.
So basically the steps of mating are, you stop using condoms after you both get STI tests. That's a big moment in a relationship. You meet her parents. That was an awkward transition. You meet her parents. You start kind of commingling money, like you don't keep track of it, or you do keep track of it. I don't know. I never did that. You move in together, and then the next step is you get a dog, because pretty soon her ovaries are going to start blinking.
You notice how I've been silent for maybe 6 minutes. I've just let you dig yourself further and further into this hole. And by the way, the thing I still cannot get over, I'm still getting over the fact that the thing that is awesome about your dog, the thing that you love, the first thing you reference is that he tries to hump everything.
Everything. Even though we chopped those nads off a while ago. No one told him.
That's what Scott loves about his dog. That, and it's a good security device.
He breaks in every visitor and pillow with a little hello in the form of a tiny dog going at it. But what I was going to say is the dog is the way to put off the baby for 12 to 24 months. It doesn't solve the problem, but it's how you practice.
Why do you want to put off the baby? I mean, I like the idea of getting some practice in.
You don't want to have kids. You're a dude. It's like getting married. No dude wants to get married. And I secretly believe deep down, no dude really wants to have kids.
So
we
wrong.
get forced into this shit.
So
Ed,
wrong.
Wake up. Wake up.
Just totally off base. Dudes love children.
Yeah, once they have them, because this instinct kicks in and they look, smell, and feel like you. So all of a sudden they start getting less. I wouldn't say you love them. They get less awful every day. But yeah, you do wake up at some point and think, okay, this isn't that bad. This isn't that bad.
A lot of wisdom. First 6 minutes of this podcast. Just make sure you're taking notes, everyone.
Little soulful dad advice. All right, Ed, let's get to the headlines.
Let's talk about the stuff that you're actually an expert in. Let's talk about business. OpenAI just unveiled Sora 2. That is its latest audio and video generator. The tool lets users create digital cameos of themselves and others in videos, and it even generates speech. Alongside it, they launched a new social platform for sharing and discovering these AI-made videos, trying to position itself as a competitor to TikTok. Meanwhile, Meta is rolling out its own version of these short-form AI clips, and it is called Vibes. This is going to be essentially like TikTok as well. So what we have here is two big AI companies, two of the biggest players in AI, both getting into the same game. And that is they're getting into AI-generated videos in a feed that will look almost exactly like TikTok. Now, some people have been very excited about this, especially Sora 2, which I don't know if you've seen these videos, but it's pretty incredible how realistic these videos are. You basically just type in your name, Ed and Scott riding a dragon, and you will get it, and it will look pretty spectacular. So some people are very excited about it. Others are less excited about it. And the reason that people are less excited about it is because what we're beginning to see is this massive inflow of what people are calling AI slop. What is AI slop? I'll just read you the Wikipedia definition, which I think is a pretty good definition. AI slop is a term for low-quality media made with generative artificial intelligence. It is characterized by an inherent lack of effort and is currently being generated at an overwhelming volume. So that is sort of the downside of these two potential social media platforms, Vibes and also Sora. Scott, I'll stop there. Let's get your reactions.
Claiming this is going to be some sort of internal social media thing, and he used the word, oh, we want to connect people. That's nothing but a false flag and a head fake from what they're really trying to do, and that is show every movie producer and executive at a studio that think about what you can do and for how much less you can do it using this technology. That there's just not going to be an intra-network TikTok for families. That's not where they're headed. When I first saw it, I thought, okay, they're trying to be the everything app. They announced they're getting into shopping. They announced they're getting into content generation or video content generation. Fine. They have to say, at least give people the perspective that at some point, as Justin Wolfers, the economist, said, the leading AI company might be able to skim off. It might be almost like a credit card. If everyone in the world had a credit card and every transaction they ever made for anything was through that credit card and they could take 2 or 3%, that company would be the most valuable company in the world. And so what they're saying is, hey, we might be in shopping, we might be in content creation, but what they're essentially saying to the world or the content creation or the movie studio world is like, imagine what you can do if you learn these skills and imagine how less expensive it'll be. And I don't know if you saw, but they've announced, and this is just fucking ridiculous, that you're going to have to opt out if you don't want them to steal your IP. So Sam, use this as official notice. I am opting out. I do not use my shit without my permission or paying me. And this, I think, was just an attempt. I think it was a branding event to say, wow, studio executives and commercial producers, and advertising agencies, get your greed gland. Gentlemen, start your greed glands. Because if we can do this fairly easily for cents or just a couple hours of time and show Family Guy talking to Wednesday, and it looks real and it's kind of cool. Imagine what you're going to be able to do for how little money. What they're clearly doing is already illegal and in violation of all sorts of IP laws. But what they're doing is they're taking a note out of the big tech playbook, and that is, why go through the hassle of establishing business licenses and standards if you're launching your ride-hailing app in Argentina? Just sign up people, start giving rides, and the fines are much less than the market cap accretion when you continue to demonstrate growth and momentum. And essentially, OpenAI has probably put $1 billion aside. They will eventually lose the case. You are not allowed to use people's likeness like this. Eventually, it'll work its way through the courts, but meanwhile, they'll keep violating people's IP, and the increase in stock price will go up. And the analogy I always use is that if you had a parking meter in front of your house that cost $100 an hour, but the ticket was 50 cents, you too would make a conscious decision to break the law. So I'm increasingly believing that Hollywood, that the Panzer tanks with David Ellison helming them are rolling over the Sepulveda Pass over the Hollywood Hills and, have the Beverly Hills Hotel and the Waldorf Astoria in their sights, or Burbank, I don't know what the right analogy is. They're coming for Hollywood and ad agencies and content creation because some of these things are just remarkable and they don't cost very much. Your thoughts, Ed?
Yeah, I think the real opportunity is in the technology and what it can how it can be used for the entertainment business. So for those big production studios, I think for ad agencies as well. What is interesting, though, is the way that they are presenting this product. I mean, they released the technology, they put out this incredible video where you can see how it works. And I mean, let's be real, it was a great ad for the product and for the technology. But I'm just fascinated by the fact that they are so dialed into this idea that it has to be a social media app. And we saw the same thing with Meta. Meta is putting these AI-generated videos and they're calling it Vibes AI, and it's its own TikTok feed that's going to be social media. And just to read you some of the quotes from OpenAI, so they in the release statement for Sora 2, they said, quote, "We see this as the beginning of a completely new era for co-creative experiences." They said, quote, "A lot of social media has moved away from the idea of friends and family connections. We believe that Sora can lean into this because it's just so easy to create." So they have this strange obsession, I think it's strange at least, with making this about socializing with other people and creating stuff with your friends. And I'm going to, oh, Scott, I'm going to make a video of you. I'm going to send it to you. And then we're going to make stuff together.
Strengthen our relationship, Ed.
Strengthen our relationship. And this to me it's just sort of not really on the right track of what they're supposed to be doing as an AI company, which is they're supposed to be selling the technology for the actual creators, the entertainment studios, to entertain us. But instead, they're taking this social media route, and same with Meta. And I wonder if these CEOs and the management team behind these companies, I wonder if they're too obsessed with this idea that we have to be social media. We have to put it in some short form content form. And ultimately, I don't think that's going to work. And we're already seeing the backlash where people are correctly saying this is just an endless stream of slop. And I love that word slop. It really does describe these videos quite well. They're photorealistic. They look pretty amazing. But then after about 2 seconds, you're like, okay, I've seen enough videos of dragons flying through the air or AI cats wearing tuxedos. I mean, it's at a certain point, it becomes very boring. Anyway, I just want to get your views on this social media angle that both companies are really driving towards.
I think they're doing the right thing. They're just lying about it. I don't think they're headed down social media. So this is what OpenAI wrote of Sora 1, open quote. Sora is becoming available to a number of visual artists, designers, and filmmakers to gain feedback on how to advance the model to be most helpful for creative professionals, which is Latin for you can make a movie or a commercial for 90% fewer people. Their objective is when putting these things out, is studios are, and again, agency executives are, their read glands are going, but I don't think Sam wants to freak out the creative community and get a ton of pushback. I think the more honest thing would be to say, hey, SAG-AFTRA and the WGA, we're coming for your bitch asses. Your membership to San Vicente Bungalows and your BMW and your vacations in Cabo are my opportunity. You're not going, this industry is ripe with fat, waste, or they're coming for them. And I think what they're doing is saying, effectively putting out an ad that will accomplish what they want, and that is demonstrate what can be done while pretending it's about connecting people.
If that is the case, I think that's the right decision from a business perspective. I mean, you look at like AI image generation, just as an example, where, I mean, you might remember when ChatGPT's image generator came out and everyone went absolutely crazy about this thing because it was pretty remarkable. And you looked at these images, and I'd type in, Scott and Ed recording a podcast in the style of Studio Ghibli. That Studio Ghibli trend was like the huge trend. Everyone was playing with this thing, and it seemed like everyone was going to be a creator. But then eventually, within about a few weeks, 3-4 weeks, suddenly no one was really generating these images anymore. And then we actually looked into the data here, and actually ever since that image generator was released, search interest for AI image generation has fallen by nearly 80%. You have another study showing that all of this AI art that exploded online, suddenly that's plummeted as well. Searches for Midjourney, that was a big name as well in the AI image generation community, that's also fallen off. Fun fact, at one point last year, searches for Scott Galloway almost overtook searches for Midjourney. And this was an illustration of this theme where it's not really, it might seem as though everyone's going to be a creator. And that might be the way you think about things at first. But ultimately, these platforms are for the consumer. And we're not interested in using the product because we want to be creating content ourselves. Some of us might be interested in creating content, but ultimately, the vast majority of us who are using the platform, we're there to consume. We want you to do the work, you being the company or the production studio or the content creator, and we're going to do the consumption. And Ben Thompson talked a little bit about this in Stratechery. There's this old internet adage called the 1% rule, which is basically this rule that it's only 1% of the users who actually create stuff. The other 99% of the users consume. Point being, if it is the case that this social media angle is just basically an advertisement or a distraction from what the real goal is, I think that is actually the right direction, because the real goal here shouldn't be trying to get everyone to create AI videos. It should be trying to sell the AI video technology to the companies who are going to create the AI videos, which are going to be distributed to all of us users. That's where they should really be headed with this.
Well, there is a non-zero probability that the anodyne nature of what these LLMs produce work for data, maybe even work for narrative, but don't work as well for creative. And that is, if you look at design, Midjourney, you would have thought initially a year ago we were saying, oh, poor design firms and poor designers, they're the first to go. What you've seen happen at tech companies is the ratio of designers to programmers has actually gone up, because as coding and the architecture of a site become less differentiated, because they can all be reverse engineered and everyone's using AI to build their sites and reduce the amount of code, the one way you can differentiate is with great UX and great design, which still requires humans. So actually design, these companies, OpenAI is hiring a ton of designers. OpenAI paid, they're so fucking stupid, $5 or $7 billion for Johnny Ive to cosplay his younger self.
Meet Sam Altman for coffee on camera.
I'm just a billionaire looking at another billionaire, asking him to make me a trillionaire.
Sam is a revolutionary.
Good God, just get a room. Anyway, but so far, designers have not only not been replaced, their role in all of this, they're the cells on the chip of AI, which is highly anodyne, you watch it and you just feel like, it's like, what's the opposite of horny? You're just like,
Depressed.
Yeah, you just feel kind of,
And it's AI. That's the other thing that's so interesting. Everyone thought that we wouldn't be able to tell. You just always know there are all these little signals, because it, as you say, yes, it is so anodyne in a way that reality somehow isn't.
But I feel that way with these superhero films, so much CGI and shit that I feel like...
Agreed. AI could make those movies.
All these things lead to one place, and that is you should go to a shelter and adopt a rescue pet and name it Midjourney. Your new dog, Midjourney.
But just going back to OpenAI as a business, I mean, I look at this Sora social media feed, and I think you guys are kind of focusing on the wrong thing. I mean, if what you say, your theory is true, that this is a distraction, and mostly they are focusing on the B2B and going to the production studios and the TV networks and the ad agencies, good, all for it. That's a revenue driver. But I think the thing that OpenAI needs to think about is they need to stop making money. Like, they've got millions and millions of users. Everyone knows about ChatGPT. They figured out all of the marketing. They figured out how to become a household name. Now is step 2. Now you need to start becoming profitable, especially if you're going to spend hundreds of billions of dollars over the next several years, especially if you're going to have to raise hundreds of billions in debt, and you don't want to get, a shitty interest rate. You need to start getting profitable. And that means monetizing the product. So go to the production studios and sell the AI technology. But there are other things that they should be focusing on. As an example, they just released the shopping feature, instant checkout, which will allow you to buy products directly on the platform. That's a good idea. I think we should be seeing more emphasis on that. But the other thing that I think we should really be seeing more emphasis from OpenAI on is turning on the ad switch. We've talked about this several times. That's the way they're going to do it. But we've seen no indication that they're doing anything to build their ad network and to build a solid ad stack. And if that's the way they're going to have to make money here. I don't see any other way they're going to do it, unless they're going to go crazy with the subscriptions. But it seems to me that that's where they should be putting all of their creative energy. Go do what Google did, where Google bought DoubleClick which was their most expensive acquisition ever, and it was just a giant ad network. And that's what really took Google into Lightspeed. So I feel like that's where OpenAI should be taking this business if they want to start getting profitable. But what do you think is the right strategy ahead for OpenAI?
I agree with you. They're likely to go shopping and make some tuck-in acquisitions and maybe a couple major acquisitions now that they have this currency worth $500 billion. And when you're trading at whatever it is, 40 times revenues, any acquisition you make is accretive. It increases your earnings per share. Where I disagree is they need to get profitable. If I were on the board of OpenAI, I would be saying we need to show growth, massive customer acquisition, and disruption of certain industries, if you will. But no, we don't want to be profitable. We just want to show massive top line growth. I don't think this company, quite frankly, needs to be profitable for 5 or 10 years, because it took, I forget how long it took Amazon, 15 or 20 years. The playbook is disruption and growth, not profitability. And there is an argument that the best AI, that there can only be one, that there's going to be one AI kind of running everything. And so leadership and growth and raising massive amounts of capital are kind of the whole game here. I would put profitability way down on the totem pole. So I don't think, because all of the margins, if you look at the gross margins on the things they do, they're usually 99%. There are no costs here. Once you've set up, there's tons of CapEx, massive CapEx, but the processing power is what the energy costs to power these data centers, but the gross margins are just near 100%. Essentially, AI has become the mother of all capital wars. Like, they don't want to spend stupidly, but as long as they can grow, show that type of top line growth. I mean, just the numbers here are just staggering, because I think they realize whoever's number one is going to trade at 10 to 30x what the number two player is. Do you want to hear my moral dilemma that fits into all of this?
Please, yeah.
Have you used my Google Labs profile yet?
No, I haven't.
Well, thank you, Ed. It's nice to see you're investing in this relationship. So just some headline news here. I get a lot of emails from young men looking for advice, usually professional advice, sometimes advice about investing, and I can't answer them all. And so about 18 months ago, the team here at Prof G built a thin layer of innovation on top of an LLM and built Prof AI, and we were getting 200-300 queries a day. Google Labs approached us. Specifically, I had a graduate student instructor, or fancy word for TA, who's just a super impressive woman who now works at Google, approached me and said, we can do much better. We're working with a bunch of thought leaders, and do you want to be one of them? I said, great, I would love to do that. They spent a lot of time on this thing, and it launched last night. And in the last 3 months, I have become increasingly uncomfortable with character AIs and synthetic relationships. Now, the upside is a lot of young people who don't have access to my content and have a specific question can get access with this thing. And I've tested it, and it's actually pretty good. I'd say it gets 70 to 90% of what I would say in the tone I would say it. In the last several months, there's been some really ugly instances of suicide and people having psychotic breaks because they thought they were in relationships with these synthetic character AIs. In addition, I hate the idea of a young man slowly but surely spending less time or taking less risks to try and establish his own mentorships and friendships in real life. And so this thing launched yesterday, and I said, well, anyways, I'll stop there. What would you suggest if you were me? Would you leave it up, or would you take it down, or what would you do?
I don't think that it's actually that valuable to have an AI giving you the answers to things. And I think a lot of the thing that is inspiring to people when they ask you questions isn't just the answer that you give, it's the fact that they actually connected with you. I mean, that to me is a big piece of reaching out to people and getting advice. I mean, the content of the answer itself is only one part of the equation here. A lot of this is about the actual connection with the individual and realizing that this person thought about my situation, recognized me as a person, and gave me a response as a human. So I don't know about taking it down, but my view on these AI avatars is I just don't think they're that valuable. I mean, I think Google if you want the answer to something and you don't really even care about connecting with the person, just go on Google and like see what Google has to say about it. I don't think that means you need to take it down. I don't think it means that you need to delete the thing. But I struggle with the value of these things from the get-go.
I think that's a really thoughtful answer. Yeah, you summarized a lot of the way I'm feeling. I feel like the ground has shifted beneath us the last 6 months. And I'm really freaked out about the idea of young men establishing synthetic relationships and using them as a replacement for organic relationships. Anyways, long story short, I pulled it down.
Oh, you did?
Yeah. I just... Something Naval said, that Twitter philosopher, I don't know what he does, but I think of him as a philosopher.
VC. They're all VCs.
He's a VC?
Yeah.
Oh, God.
Angel investor. He's started companies as well.
Really? Yeah. Anyways, he said something that really struck with me, and that is if you're spending a lot of time trying to decide something, the answer is almost always no. And I thought, yeah, there might be some missed opportunity to get good advice, but I'm like, they can read a book, they can dial into office hours, they can read one of my newsletters. But I just hate anything that reduces a young man's fire to go up to a teacher, a boss, a potential boss, or whoever, or email me and try and make some sort of personal connection.
We'll be right back after the break. If you're enjoying the show so far, please vote for us at the Signal Awards. We'll leave a link in the description to make it easy for you. Thank you, and stay with us. Support for Prof G Markets comes from Quince. As the weather cools, I'm swapping out my summer fits for my warm, durable, and comfy clothes, and Quince delivers every time with wardrobe staples that'll carry you through the season, like their 100% Mongolian cashmere from just $60, a classic fit denim, and real leather and wool outerwear that looks sharp and holds up. Their suede trucker jacket is perfect for layering and just looks really casual but put together. By partnering directly with top artisans, Quince cuts out the middlemen to deliver premium quality at half the cost of similar brands. I've tried some pieces from Quince myself. I've tried their linen shirts. I've tried their cashmere sweater. Love all of their products. I highly recommend. You can layer up this fall with pieces that feel as good as they look. Go to quince.com/markets for free shipping on your order and 365-day returns. Now available in Canada too. That's QUINCE.com/markets. Free shipping and 365-day returns. Quince.com/markets.
Support for the show comes from Public.com. You might already use AI tools to refine your emails and streamline your workflow, so why not see if it can optimize your investing as well? For that, you can check out Public.com. Public.com is the investing platform that takes your money as seriously as you do. With Public, you can build a multi-asset portfolio of stocks, bonds, options, and more. You can also access industry-leading yields, including the 4.1% APY you can earn on your cash with no fees or minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. And the best part? You can earn up to $10,000 when you transfer your existing portfolio over to Public. Go to public.com/ProfG to fund your account in 5 minutes. That's public.com/ProfG. Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for U.S.-listed registered securities, options, and bonds in a self-directed account are offered by Public Investing, Inc., member FINRA, and SIPC. Complete disclosures available at public.com/disclosures.
We're back with Prof G Markets. Deal-making surged in the third quarter, with global M&A topping $1 trillion for the second time ever. The main standout was EA's $55 billion buyout, which we covered on The Daily Show. But beyond that, there were also 13 mega deals that surpassed $10 billion each. What is also surprising is how the landscape has shifted. The scale of the deals is getting bigger, but the total number of deals hasn't budged. Total deal value jumped 27% year over year, even as deal volume stayed flat. So, Scott, you actually predicted that M&A would be the business trend of 2025. You also predicted that we'd see the largest take private ever. Let's play the clip of your prediction.
Corporations have record profits. They're running out of growth. And if they're in challenged industries, they want to bulk up. You're just going to see tons of M&A here. M&A has been largely moribund because the Biden administration was enacting more FTC and DOJ reviews, which, by the way, I think was the right thing to do. But you're going to have a much more M&A friendly head of the FTC and the DOJ now. And these companies have so much money on their balance sheets, they're just going to go shopping.
So we have got $1 trillion in M&A in the third quarter and $3 trillion so far this year. That total number is up 35% year over year. Crushed it on that prediction. What was the incentive or what was the impetus for that prediction?
So the way I would describe it is, for a small set of companies, everything's 50 or 80% off. And that is, if you're Palantir Technologies and you're worth $440 billion, and just 5 years ago, right, you were worth $20 billion, everything is on sale for 95% off. Because when you buy a company, you issue shares to buy it. So let me put it another way. Like, when I raise your salary from $10 an hour to $20 an hour, technically your rent gets cut in half as a percent of what would be required for you to sacrifice. So when OpenAI goes from being worth $20 billion to $440 billion in 5 years, the universe of potential acquisitions goes up 1,000-fold. In addition, when they're trading at 50 times revenues or whatever it is, any acquisition they make is technically accretive that increases their earnings per share. So when a banker, bankers meet with Karp every few weeks, and they're really smart people. They look at different channels, distribution strategy, understand your strategy. Wouldn't this be a great tuck-in strategy? Because they're trying to figure out a way to generate fees. The book of potential strategic options now in terms of acquisitions has gone from 2 pages to 200. And so what are we going to see here? I think, so the prediction was we'd see the biggest take private. That's happened. What we're going to probably see in the next 6 months is the biggest merger or acquisition in history. Because if you're NVIDIA and you're trading at a $4.5 trillion market cap, you can go buy a $100 billion company for a 2.5% bet. You can bet the bankers are working overtime, and the selection set and the opportunity to go buy a company worth 50, 100, or 200 billion, that wasn't even thinkable before. It all spells one thing. We have not seen anything yet. We are going to see some just titanic deals. In addition, you layer on top of the fact that essentially the DOJ and the FTC have somewhat been anesthetized. They're just under. They're just not awake right now. So all of these moons are lining up to where this is banker Lollapalooza. You're going to see the largest banking fee ever registered on a deal in the next 6 months. It'll be because the wonderful thing about M&A, when I was working at Morgan Stanley, it's all perspective. The deal doesn't close, you get zero. But if the deal closes, the fees are outrageous, because if someone is pitching OpenAI and says, all right, Gartner's stock is down, they have some good IP around technology, you should just acquire them, and they're worth $12 billion, you can acquire, you can acquire them for $15 billion. They're not going to argue over whether the fee is $140 million or $170. They brought us the deal. They have to rally 40 people to work day and night for 90 days to close this thing. So your margins are just extraordinary. There's very little pricing pressure in M&A. The lawyers rack up their bills, inflate their bills. Everyone just makes a shit ton of money because there's, it's almost like the real estate business. That is an incredibly inefficient business where, your friend Marge, who's very friendly and, went to junior college and knows everybody, can get 5% or split with another person 5% of the value of your home by figuring out a transaction. And it's all based on relationships. Anyways, we're going to see more of this. In my opinion, it's only getting started.
Yeah, and that's the bank earnings when earnings season comes up will be so interesting. But if you're wondering why is JP Morgan up 30% year to date, why is Goldman up 37% year to date, why is Citigroup up 41% year to date, why are all the bank stocks absolutely ripping in 2025? This is the answer. It is M&A. Banks have generated $95 billion in investment banking fees this year, and that is the second highest in this time frame ever. So these banks are absolutely printing money on these gigantic deals. And we've seen a ton of these mega deals. We saw, I mentioned the EA take private, $55 billion. We saw Palo Alto Networks buying CyberArk for $25 billion, Anglo American buying tech for $50 billion. We're seeing these gigantic deals. Now, the one thing that I find very interesting, and I'd like to get your reaction to, record M&A market in terms of dollar value, deal size, but not a record M&A market in terms of deal count, the actual number of deals that are happening. So what is actually happening here when you dig into the numbers? Basically, what's happening is you're seeing a ton of deal making among really big companies, large caps, and then the opposite is happening among small cap companies. So just the numbers here. Deals worth less than $500 million are down 18% this year. Deals worth less than $2 billion are down 25% this year. Deals worth more than $10 billion are up 26% this year. So what you have is the gigantic companies are getting acquired, and no one's really touching the small companies. And this reminds me very much of the discussion that we've been having when we look at the GDP data and we look at the underlying economic data among consumers in America. The numbers are going up, but then you dig into it and you realize, okay, actually, let's look at it by bracket, by income. Hold on, the very top are the ones that are creating all of this activity. And when we look at the bottom, actually, the activity is in decline. So we saw that in the consumer market, and we're seeing it as well in M&A. The small companies are not really being touched when it comes to these big acquisitions. Your reactions?
So first off, 2/3 of acquisitions fail. People get excited about them. They have to pay a premium. Integration is always more costly and timely than you thought. 2/3 of them end up not working. And also, integrating a $1 billion acquisition isn't much easier than integrating, a $20 billion acquisition. So you have, and then the companies making smaller acquisitions are the S&P 490, right? Meanwhile, the big guys have made so much freaking money, and it goes back to what we were talking about before. The opportunity set or target market has expanded exponentially because now they can afford to buy almost anyone. So it would just make sense that the S&P 490, who have not registered the same returns, don't feel as flush or as rich, and are, by the way, usually dodging incoming projectiles in the form of tariffs and all this other nonsense, are not out shopping because they don't feel like their stocks are inflated. They don't feel like they have their preloaded credit card. Whereas the big guys are like, yeah, fuck, I could go buy Ford Motor right now. Like, pitch it to me. I mean, or whatever the company is. So it would make sense that it's the big game. If you saw a run up in the Russell that tracks small business, or small caps, you would see. And oftentimes traditionally small caps have outperformed the big guys because they're supposed to be more nimble. That dynamic has entirely changed the last couple of decades. Of the 500 companies that were unacquirable because they were so big, like, no one would have thought of buying Chevron. They could have merged with them, but they couldn't buy them. Now it's acquirable. There's companies out there. There are pools of capital, and there are companies with market caps that now make these companies acquirable. So I just think it's just a function of the haves and the have-nots. The haves have preloaded credit cards, the likes of which they've never had before. The have-nots, the mediums and the smaller cap guys, are kind of licking their wounds, waiting to see if their tariffs on Brazil is going to go to 100% based on the blood sugar level of the president.
I just find it remarkable how every story we dig into on this show, the more you keep digging, ultimately there is one trend that just runs through all of it, and it's inequality. Like, we see it in the consumer economy. We see it in the stock market. I mean, the fact that the Mag 7 now makes up 35% of the entire market cap of the S&P right now. And you look just a few years ago, 2019, it was 19%. So you've gone from a fifth to a third in just about 5 years. And the downstream effects of that inequality are spreading out everywhere, including M&A of all markets. I mean, the fact that if you want to get bought as a company, you need to hope that you are worth at least $10 billion. Otherwise, the chances of you getting acquired are actually lower than they were a year or 2 years ago. And then what is even more interesting is the fact that because the dollar amounts are so big on those big deals, it distorts all of the data and it makes you think, oh, this is this giant M&A market. Everyone's making deals. And then if you're a small company, you're like, well, why isn't it happening to me? And the reality is you're not an exception, actually. You and the rest of the other small cap companies are not getting acquired. It's just the big dogs at the top. And we see this everywhere. And I think the other interesting question that we have to go to then is, what does that mean? I mean, what are the implications of that? What does that mean for smaller companies? What does it mean for a company like us, like Prof G Media? We're not a large cap. We're not a mid cap. We are a small startup. What does it also mean for entrepreneurs and founders who are probably going to realize that there is just simply not a lot of exit opportunity unless you are a 10, 20, 25, $30 billion company?
What you have is a situation where a small number of companies are going to garner the majority of the spoils, and the 99% of the rest of us and companies are going to have the oxygen sucked out of the room. What do you do, or what does it mean? It means it's a winner-take-all economy, which plays into an unfortunate or a double-edged sword of American society, and that is our superpower is our optimism. We all believe that our kid is that 1% or that our company is going to be the big winner. And the downside is we don't recognize that it is getting harder and harder to break through. The spoils are greater if you break through, but it's getting harder and harder. So I think where we're headed is the following: civil unrest, or just unrest at the ballot box. And I do think the opportunity is really ripe for massive antitrust that comes in and says, okay, Apple, you're not Apple, you're 5 companies. Why does the App Store have to live with you? Oh, Google, why on earth do you own the largest streaming video service and the largest autonomous automobile company? And you coordinate and cooperate with each other, making it hard for smaller companies to break through. So I think you're going to see, I'm hopeful that at some point, then it's not going to happen in this administration, but in the next administration, I think you're going to see a lot of mojo and justification to go in and oxygenate the economy with a massive breakup of the big guys, the winners, because some of these companies, how do you compete with them?
And I think there's the question of when people are going to wake up to the fact that this administration lied to them about all of this. I think the funniest lie that we saw was at the beginning when Scott Bessent said, it's Main Street's turn. It's not about Wall Street anymore. It's about Main Street. I'll just point you right back to what we said at the beginning. JP Morgan up 30%, Goldman up 37%, Citigroup up 41%, $95 billion in investment banking fees this year, the second highest in the history of Wall Street. The fact that the Mag 7 is ripping right now. I mean, this is the same thing again. It's just the only difference with this administration is that we were promised something completely different.
To your point, the big guys, right, up 30 to 40% off of huge market caps. I just typed in regional bank index, and there's something called the KSW NASDAQ Regional Banking Index. It's up 1.5% this year. It's flat. Yeah. So it's pretty simple. How are you doing? Are you small or are you big? And anyways, there needs to be, I believe what Vice President Mike Pence said. He and I were at the same Atlantic festival together.
Oh, wow.
Yeah, me and Vice President Pence. He said, the best economies are refereed capitalism. And right now, we've never had bigger, meaner players on the field. The referee's nowhere to be found.
We'll be right back after the break. And for more markets content, hit follow and sign up for our newsletter at profgmarkets.com/subscribe.
Support for the show comes from Vanta. Are you a startup founder or security professional? If so, you're going to want to listen up. Navigating vendor security requirements can be challenging. Facing your first security compliance audit can be downright scary. With Vanta, it doesn't have to be. Vanta is a trust management platform that helps businesses automate security and compliance, enabling them to demonstrate strong security practices and scale. Simply put, your company can't grow if it can't prove that it's meeting security standards, including SOC 2, ISO 27001, and HIPAA. Vanta can get you audit ready in weeks instead of months, saving you up to 85% of associated costs. And Vanta scales with your business, helping you continuously monitor compliance, unify risk management, and streamline security reviews all in one place. More than 10,000 global businesses trust Vanta to achieve compliance and save them time while they're at it. Starting and running a business is hard. Let Vanta help make it a little bit easier. Go to vanta.com/markets to meet with a Vanta expert about your business needs. That's vanta.com/markets. Support for the show comes from Workday, the to-do list of a small business leader. Close the books, get your people paid, and bring on new hires. Look, running a small or mid-sized business can be exciting, but it can also be chaotic. That's where Workday comes in. Workday Go makes simplifying your business a whole lot simpler. Imagine this, the important aspects of your company, HR and finance, all on one AI platform. No more juggling multiple systems, no more worrying about growing too fast. Just the full power of Workday helping small to mid-sized businesses like yours run more smoothly. And Workday Go activates quickly. You can be up and running in 30 to 60 business days. So, simplify your business. Go for growth. Go with Workday Go. Visit workday.com/go to learn more.
We're back with Prof G Markets. Last week, Charlie Javice was sentenced to 7 years in prison for defrauding JP Morgan. Back in 2021, she convinced the bank to pay $175 million for her startup, claiming it had 4 million users. In reality, the platform never had more than 300,000 users. So this case raises a bigger question, a question we've asked on the podcast before, and that is, where is the line between visionary storytelling and outright fraud? And we've seen this question before when it came to Elizabeth Holmes, when it came to Sam Bankman-Fried. And we might even be seeing it today in AI, where many investors are worried about these creative accounting issues, where, one of the biggest things we're seeing is this ARR accounting magic, where companies are signing these one-off contracts and then they're annualizing those numbers as ARR to make it seem like they're making more money than they actually are. That's probably another talk track. But the point being, we have here yet another example of a founder who flew too close to the sun, crossed that line. It was storytelling and then it was fraud, and now she's in prison. So Scott, you've spoken about this before. You've built many companies. Your reaction to this news and your thoughts on where do you draw that line as a salesman, as a storyteller, and as a founder?
Well, I empathize with her because in college, when I'd go on a date, I would borrow my mom's Acura Legend and I would say it was mine. Because no woman can resist the Acura Legend, the smooth, clean lines and the mellow acceleration of the premium brand from Honda. Look, she committed outright fraud. If you're in due diligence and you're asked to put into the data room a list of your clients and you work, I guess she was working with some academic who figured out a way to manufacture like sort of accounts that look sort of real, that's fraud. You should probably go to prison. There is a fine line, though, and this was not a fine line, but really being out there and embellishing the prospects of your company and the performance and recategorizing what's ARR and what isn't regular revenues, what is services revenue, what is technology revenue to try and increase. Remember that company we called out and eventually went bankrupt? I think we were one of the first ones. A bunch of my buddies invested in LA and called me and got angry. Remember that credit card that was claiming to solve the climate crisis, and it was just a fucking credit card?
Aspiration.
You can say that you're raising the consciousness of the planet, and it's buyer beware. But if you start lying about specifically financial results, that's when you get into trouble. There is some political and brand issues, though, and that is, I think the difference between Elizabeth Holmes and Adam Neumann is that Adam Neumann's board wanted to save face and gave him, no one has ever gotten a $10 billion commission on losing, or a $1 billion commission on losing $11 billion of other people's money. And I think the board, if his board had been angrier, I think he would have been a world of hurt. Elizabeth Holmes Theranos' board was angry. And I always thought it was just sort of uncomfortable that the first person that got sentenced to a decade-long prison membership happened to have ovaries. 2% of unicorn founders are female, and the most famous one got stuck in prison. And there was some misinformation around that. No one ever got a false diagnosis. What she did was she lied about the capabilities of the machine, and she did lie about some of the order volume, I believe. But it wasn't people saying, well, it's different, it's health. No one was getting like HIV negative results when they were HIV positive from these machines. She was exaggerating the capability of the machines. Anyway, I think that there is a fine line between, well, let me go. I think when you say, I'm taking the company private and for $420 a share and funding secured, and you're like, wow, the stock goes to 400, but it's going to be at 420, so you buy in at 400, and then you find out that the guy was either on ketamine or lying, and the stock plummets.
This is Elon a few years ago. Yeah.
You're lying about finance. You're lying about numbers. There's an objective truth around what he said, and that was not it. That was a lie. So yeah, look, the whole thing is a cautionary tale that if you're the CEO of a startup, you have to be able to spin a narrative that gets people's greed glands going. And sometimes there's a thin line between exaggeration and downright lying. But what you should never, ever lie about is the numbers, or number of customer accounts, the revenues. They all play with like categorizing or recategorizing revenues as a certain type of revenues or pulling revenues forward, all that bullshit. Public companies do it all the time. I think AI is going to serve a really valuable role in terms of issuing sort of a diligence or a good housekeeping seal of approval. Now, projecting the future is not lying. You can just be wrong. But this is, I think it's a real cautionary tale, and she's going to spend the majority of her, younger years in prison now. It's a real tragedy for her, for the firm. But she picked the wrong company to fuck with, because if it had been a smaller company that just wanted to ignore it and not be embarrassed, they might have just let the whole thing go.
Yeah, I think the thing that's a shame is that it's, I mean, your point about Elizabeth Holmes and perhaps the justice system and the world was too harsh on her. It's almost like on the way up, when the stock's up, you're a visionary. When the stock's down, you're a fraudster. And that's the part that is, I think, a little bit unfair, is why is it that we're down to accept the lying when things look like they're going well? It's because we're all down to buy into the lie because there's the prospect of making money on it. And the perfect example of that is Elon. I mean, Elon is committing, as you say, fraud when he says, funding secured, $420 or $410 a share. He's kind of committing fraud, again, sort of blurring the line. But when he says that we're going to have 1 million robotaxis on the road by next year, and then 10 years later they have 2, I mean, that's another form of lying that, is something we should look down upon. But the reason that we don't, or the reason that we turn a blind eye, is because we look at the stock price, and the stock price is up. And so people decide, oh, whatever, it doesn't matter, he's a visionary. But as soon as that stock comes crashing back down, suddenly people get very sensitive about the difference between fraud and lying and exaggeration. Same thing happened with Sam Bankman-Fried. Everyone was down for it while that FTT token was going up. As soon as it came crashing down, suddenly everyone got their investigative hats on, and they decided that they were investigating fraud. But it's like, okay, well, where was that energy when he was out raising money from Sequoia and all these other big VCs, and making billions of dollars on this FTT token? And by the way, I think the perfect example of this, which we talked about in one of the episodes, what is the next aspiration? What is the next WeWork? In my view, it's this company Fermi America, which just went public last week. And one of the things I predicted on the episode is that we would see a big pop in the stock because it would have this AI feel to it. It's sort of got this meme stocky potential. That is indeed what happened. Shares closed up 54% on their first day of trading. It's at a $15 billion valuation right now. But I mean, this is a company that has zero revenue. And they say that they're going to revolutionize AI because they are building a power grid and they're going to have nuclear power plants and they're going to bring 11 gigawatts of energy to AI companies, which is 5 times greater than the output of the Hoover Dam. It's 2.5 times greater than the amount of energy consumed by all of Manhattan. I mean, they're pumping this story, and yet they have zero revenue. They also don't even own any infrastructure. All they have is a contract to have some gas turbines that are currently sitting disassembled all around the world. And so again, perfect example. In my view, this company comes crashing down the same way as Aspiration. That's my prediction on Fermi America. But the stock's up, so people don't care.
I love this. By the way, it's down 7% today. When I remember right in 99, after I'd sold Profit, I came to New York and I said, I'm going to be the Idea Labs in New York. One tech team, one engineering team, one office space, one legal team, one corp dev team, and I'm going to punch out e-commerce concepts. And I raised $15 million at a pre-money of $35 million. So me and a PowerPoint presentation were worth $35 million. And I remember thinking, this feels wrong. Like this, I'm going to call my lawyer. Like, can I get in trouble now? No, these are accredited investors. They're smart people. Goldman invested, JP Morgan invested. Anyway, this is essentially, this company right now has a $14 billion market cap. This is a company with a management team and a business plan that is worth $14 billion. And I mean, unfortunately, they're not trading options yet. I think something has to be out for 30 or 60 days. This company, it's at $30. This thing's going to be single digits in 30 days. Or, I mean, this company at 18 billion, you're right. This is look out below. Look out below.
Let's take a look at the week ahead. We'll see earnings from Constellation Brands. That's the distributor of beers like Modelo and Corona. We'll also see earnings from Pepsi and Delta. We likely won't get any of the scheduled economic data because of the shutdown. However, we should still see the minutes from the Federal Reserve September meeting, and we'll be watching that release for signals of the Fed's path forward. Scott, any predictions?
Well, it goes along the lines of the biggest M&A and mergers in history. All the moons are lining up. And this is one that is a little bit out there, but I see the industrial logic behind it. And that is, I think Netflix, with a $440 billion market cap, is likely to make a tectonic acquisition. And my thinking is that there are a lot of existential threats right now around Netflix. Specifically, I think we're raising a generation of consumers who can't sit still for 90 minutes or 60 minutes. I think the TV screen is getting turned on so little that it's going to start impacting their business. I don't know about you. It's really strange. In the last 6 months, I've stopped turning on the TV. I don't watch TV anymore. It's really weird. I used to watch, it used to be appointment viewing. It used to be just always on. Then I went to appointment viewing. Now my TV's never on unless occasionally I have a Premier League game on. And my kids never have the TV on. In addition, when you look at what AI is doing around content creation, it could work for Netflix, it might not. And it's trading at a market cap of
$490 billion.
490 and a PE of 50. So my favorite is, and they wouldn't call it an acquisition, they'd call it a merger. But I think if Netflix were to merge with and or acquire Disney, it would make all sorts of industrial logic. Why? Disney has a management and succession problem. Right now, the person running Disney could best be described as Neville Chamberlain in a cashmere sweater minus the dignity. He's a 73-year-old man who has fucked up and shown incredibly poor judgment around some key decisions. The person who was supposed to be a successor, or one of his successors, has gotten caught up in this Jimmy Kimmel nonsense. Netflix has an enormously talented management team. The co-CEO, who you never hear about, you hear about Ted Sarandos, who's probably demonstrates more aplomb than any media executive in history. It's just hard not to like a guy who's built a $500 billion company. Actually, you'd say, well, the vision of Reed Hastings, who started working in video stores, right? His co-CEO is extraordinarily talented. They have 2 great CEOs and an unbelievable bench there. So that solves the management problem. In addition, If Netflix faces these existential threats of being totally focused on this one business called streaming, Disney has this singular business, parks and cruises, place-based entertainment, nothing like it. Their Broadway shows of The Lion King, their parks, just singular. No, OpenAI and whoever it is, Snap or a name of NVIDIA, these companies can't replicate Disneyland and Disney cruises and Disney Broadway theaters. Where they're getting a little bit long in the tooth is the IP in those parks. Darth Vader, Cinderella, the Muppets. This shit's getting a little tired. What does Netflix have? Oh my gosh, the Stranger Things ride at Disneyland? Can you imagine the wait for that shit? The Squid Games competition, the Wednesday Broadway show. The two of these together, the IP in the parks, accretive from a management standpoint, and then you have one streaming platform that is Netflix, Disney, and Hulu. It's game over in streaming. Now, this merger should not be allowed to happen because it would be so fucking dominant. It would create the first $1 trillion true kind of old Hollywood media company. But it could get through now because, again, see above the DOJ and the FTC are asleep at the switch. So Netflix has a stock that is so fully valued, I think their bankers are probably getting some reception from the management team thinking, how are we going to grow Netflix to justify this position given some of the threats on the horizon? We have this amazing company where the C-suite, there is 5 years past their expiration date, and we have a huge management team. We have all this IP we could monetize downstream, which we aren't monetizing right now in the form of place-based entertainment, which is much more enduring than this streaming war. I think that Netflix is going to make a tectonic acquisition, and my favorite candidate is Disney.
I really like that prediction. I just want to add on to it. I agree with you. They need to do something to justify this valuation, $500 billion, 50 times earnings. If they don't, the stock's coming down. And this is all to say, I'm very bearish on Netflix. I really don't think it has any business trading at $500 billion. So we'll see what happens in terms of M&A, but I'll just add my prediction on bearish Netflix. Perhaps we should dig into that next week.
Let's do it.
Thank you for listening to Prof G Markets from Prof G Media. Tune in tomorrow for a fresh take on the markets.